Thanks for joining us on the Lyons Share podcast. I'm Mark Elliott alongside Mitch Lyons, financial advisor and CEO of Mitch Lyons Wealth. We're going to be talking about rebalancing your portfolio in this segment. Rebalancing, is it important? Is it not? Well, Mitch will clue us in right after this. We're going to talk this segment, I think, about something that, we were talking earlier about the fact that, inflation is something that people kind of overlook when they're thinking about retirement. They also kind of forget about taxes. My taxes, when I retire, the old adage was when I retire, I'm going to go to lower taxes. But in today's world of traditional 401ks and IRAs, when you hit RMD age of 73 or 75, depending upon when you were born, your taxes could actually go up if you haven't had a strategy for that. But rebalancing your portfolio is a topic that I know financial advisors like you, Mitch, find this to be very important. For somebody like me that doesn't really understand all of this, what is rebalancing? How important is it? Does everybody need to rebalance? I don't know. Explain it to us.
Rebalancing really comes down to making sure that you're staying within the constraints of what you're comfortable with from a risk standpoint, right? When we sit down with folks, we do a risk assessment of what are they comfortable with in terms of market volatility, right? Everybody, if the market just went up 10% a year, everybody would be fine and dandy and nobody would have a problem, right? But it doesn't work like that. Even if it averaged 10% a year over 20 years, you're going to have some ups and downs along the way. And depending on when you take those losses, that can really impact a retirement, right? Sequence of returns risk is a very large risk in retirement. It's different while you're accumulating for 30 years. When all of a sudden you start taking money out of your nest egg and you have some market losses, that can be critically damaging to your retirement hopes and dreams. So rebalancing is really, if you are comfortable and we deem it that, maybe you need a 60-40 stock versus bonds or some sort of fixed asset to create the stability in your portfolio and brings you comfort. Well, if stocks go crazy one year and all of a sudden now it's 70% of your portfolio, now you're 70-30, that's probably a little more risky than you want to be. And if the market were to take a swan song the next year, you're going to take a bigger loss than what you're comfortable with. So it's important to stay on top of that. That's something we monitor. When we do an initial plan for folks, we always say, listen, this is a rifle shot in time. But we're looking at it in today's numbers. That's why it's important to get together each year and make sure that we update everything. And as I say, keep you between the rumble strips, right? Going down life's highway as we go through retirement. Rebalancing is part of that. Those are some of the the rumble strips we use to make sure that we're not taking on too much risk and putting you in jeopardy.
And so in listening to you talk about rebalancing, it seems to me, so you go back to 2022, stocks and bonds were down for only the third time in history at the same time. It's very unusual. Both stocks and bonds were down. Mm-hmm. But you go look at the last 3 years of the S&P, for example, 2023, 2024, 2025, they were up 23%, 24%, 18%. I mean, the market's been up for the last 3 years. Is that the kind of run that kind of leads to a little bit of rebalance? We might get a little over heavy maybe in the stock department because we've had that little run.
Yeah, it's great that the market's gone up, right? But let's protect some of those gains along the way and rebalance and get that thing spread back out into some different baskets. Whether that's a bond portfolio or CDs, or whether it's using some fixed annuities or other mechanism strategies that we can protect against downside risk. Again, because as you get into retirement, the game changes. As I say, the retirement red zone, kind of like in football, you get in that last 20 yards of the field, things tighten up and decisions become a little quicker, and you don't have as much room to work with. And we don't want to make a critical error or turnover, if you will, in retirement. So rebalancing is important. And just managing the ups and downs of a stock market anyway, right? It's not always bad. People think if the market's down, it's bad. Well, sometimes market being down is a great time. If we're looking at doing Roth conversions, well, that might be a time we want to do more of a Roth conversion in a year. The market's down. You don't have as much tax that you'll have to pay. You can convert those dollars in that year, pay less tax than you would have the year before. And now when it bounces back up, you're getting all tax-free gains. So that's all, again, a lot of pieces to the puzzle, but that all works together. And that's why we like to sit down with folks on a regular basis and make sure we're keeping track of it all.
And you mentioned the Roth blueprints and Roth, whether you do it for whatever reason, is it for taxes or down the line, having money that you can pull out that's going to grow tax-free, you have a Roth blueprint offer. Why don't you clue the people in on what that is all about?
Yeah, right. I mean, in Roth conversions, I think everyone's heard of them, and people, I think, tend to simplify it a little too much. They think, well, if I'm going to be at a higher tax bracket later, it makes sense to do the Roth conversion now. If I want to be in a lower tax bracket later, everybody thinks, oh, we're going to put money in a 401 because I'll be in a lower tax bracket in retirement. Maybe that's true. And if that's true, a Roth conversion may or may not make sense. It's not just cut and dried, because we look at not the what's your future tax rate. It's really what is your break-even tax rate to make a Roth conversion make sense. And that there's a lot of parameters that go into that. But that's something we can talk to folks about, because there's other things to consider when you start talking about taking money out of a taxable account. There's IRMA charges, surcharges on your Medicare. There's taxation on Social Security benefits. So, and just from the measure standard of principle of controlling your money, having more control. And I talk about, hey, if you can get money in a tax-free bucket, that gives you a lot more control down the road. You're not going to be subject to what if interest rate or tax rates do go up in the future. Well, you're fine if you got it in a Roth IRA. But even if that tax rate was lower, RMDs might be forcing you up into a higher tax bracket than maybe you were during your working years. Or, a lot of folks won't necessarily spend all their IRAs. So who are they going to give it to? They're going to give it to their kids, who probably are in a higher tax bracket than they are, because they're in their peak working years, earning years still, and they're going to pay an even higher tax rate than mom or dad would. So if you can get those monies converted to a tax-free bucket, it increases your lifetime wealth way more than leaving it stuck in a taxable account.
We're talking rebalancing on the program right now, and one of the challenges for, I think, a lot of people, really, number one, you just explained what rebalancing was, right? Stock market went on a run. You got maybe a little over heavy in the stock side of your portfolio. Now we need to rebalance it, kind of get it back to where we started. How often should people be looking at rebalancing? Is this something they do once a year, after a market run? What is there a rule of thumb?
Rule of thumbs get you in trouble, I find. I think every situation is a little different. How close are you to retirement, right? And people tend to be emotional when it comes to the markets. When the market's going well, like the last few years, geez, they don't want to get out of the market because I don't want to miss an opportunity. Now, if the market was down for 3 straight years, like 2000, 2001, and 2002, all of a sudden people are heading for the hills and they don't want to tip their toe in the market, right? We need to be pragmatic about it. And how close are you? We've had a great run up, and if you've gotten over leveraged on the stock portion of your portfolio, let's take some of that risk off the table. Let's protect it. Again, let's look at your overall situation. Are you set from an income standpoint that when you turn on the retirement and you stop getting those paychecks from your employer, and now it's time to create paychecks for yourself, whether that's Social Security, pension, IRA distributions, whatever it might be, let's make sure that we have that set up. And if you have that set up, you can test the waters of the market and with a longer time horizon, because you're not dependent on that bucket for your income. If we have the income taken care of, we can ride the up and down roller coaster of the stock market without worry.
So if somebody called you and said, Mitch, I'm 65 years old. I've never rebalanced my portfolio. I've just put it in the 401k, went to work every day, and now I'm getting close to retirement. I have no idea how I'm sitting. And you talked about stress testing and all of that. Can you kind of explain how the rebalancing works, stress test, all that kind of stuff?
Yeah, when we use our software for a retirement plan, we're gonna factor in. Number one, we're gonna start with that risk assessment, right? What are you comfortable with? And we get this a lot, right? People have been saving. I talk about the accumulation phase of your life, right? You've been working for 30 years. You've been dollar cost averaging in, having money put in your 401 every paycheck. And it's probably worked out pretty well for you if you were in the market for all that length of time. But again, now you're approaching a retirement, which I call the decumulation phase, when you're going to start taking money out. And that's an entirely different game, right? Because when, if you start having market losses at the same time you're taking, 4 or 5% out of your portfolio, you can start getting that snowball going the wrong way down the hill, and you're going to start losing portfolio and then start putting your retirement in jeopardy. So when we look at somebody's overall portfolio, we're going to look at your 401k assets and what you have in Social Security and what you might have in pension, and what are your goals? How much do you want a month in income? And what are your life expectancies, your health, and all that? We factor all that in, and we can sit right down on a Zoom with them and show you exactly, based on the factors we've put in, what it looks like for you, factoring in inflation, factoring in X% of perceived market returns over the long haul, and we can change those factors right in real time and see what would happen if we got an extra percent on our returns, or 1% less, or if inflation was 1% higher. So we can do all that and let people see where they fall.